Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Markets give up gains to trade just marginally lower as metal and oil marketing companies are the laggards. US Federal Reserve increases the benchmark rate by a quarter of a point and forecasts a steeper path in 2019 and 2020, but sticks to the three rate hikes this year. Busy day at the Kolkata NCLT with at least 13 petitions being filed by various stakeholders in the Binani insolvency case. Sun Pharma is one of the top Nifty gainers after the US FDA clears a specialty drug it hopes to market in the world's largest drug market. All right, quick check on how the markets have been faring today. Neeraj is here with a closer look. It's been a day of volatility. That should be clearly the broader theme.
Yeah, did well during a portion of the day as well. Went up to the day's high almost at the end of the first 1 hour of trade. Since then has come off. And yeah, as the chart shows, there's a bit of volatility. Though VIX by itself has come off a little bit, but it's been mildly volatile. There you see the India VIX has come off a little bit, but mildly volatile the day today. Upstream, I think, is giving that bit of support to the markets today. So look at ONGC, look at Reliance. GAIL was in the positive as well. Certain oil explorers at the small cap end of the market too are doing okay. So upstream is doing well, downstream is not. BP, HP, IOC are feeling the brunt of selling pressure. So there's a bit of a tug of war between the oil and gas space in today's session, and equal and opposite reactions that are coming into these set of stocks. There is some bit of traction that we're seeing, or some bit of loss of traction we're seeing in yesterday's gainers, Harsha. So, you know, all those stocks which started moving out in the hope that the rally might continue, the Balrampur, Chinis, TV Todays of the world, have all gone down today. So that portion of the move is over. The only question mark again to today's session, as was the case yesterday, you remember we were talking about how volumes would have remained thin before the Fed meeting. It'll be interesting to look at the volume number today. Sadly, they haven't really picked up too dramatically. One would have thought that if indeed once the Fed decision is out of the way, the volumes will pick up. Not really. At the same time, yesterday it was about 15,000 crores. It's the same number today. So participation has really gone down. I don't know if it's a global phenomenon, but in India, the participation on the cash chart has suddenly gone down. Maybe people are just playing it light ahead of now the earnings season coming up. Or maybe we're just looking for reasons as to why the volumes are low. But the volumes have certainly gone down, and gone down quite dramatically.
Sure, Neeraj, thank you so much for putting that in perspective. That's the markets for you. Now let's get to the big story. This is the latest on the Binani Cement insolvency. And today the focus is clearly on the Kolkata NCLT of the National Company Law Tribunal, where at least 13 petitions have been lined up by different stakeholders in the case. They started hearing arguments from around 11 o'clock today and already made some observations in the matter. Vishwanath Nair is standing by with some details. This is not going to get over anytime soon, but what do we know at this juncture?
So at this point in time, the NCLT has been hearing all sides involved, right? So there's largely the resolution professional in the matter who has been giving his opinion on what exactly he thinks has happened in the case. He's pointed out firstly that there are some problematic transactions that had happened because of Binani Industries involved in Binani Cement. We saw that in media reports, and that there was a forensic audit that was conducted. So he obviously gave details on that. In response to that, the Binani Cement, Binani Industries people have said that the resolution professional himself has misused some of the insurance funds that are there, about 72 lakh rupees. And to that, the NCLT made the observation that if there is a misuse of funds, please go to the IBBI, which is the agency that manages all issues relating to the resolution professional. There's also the point about whether there was a revised offer made by Ultratech at all or not. So what the RP claims is that on the 8th of March, there was a revised offer, which is just a number sent on email to the COC, after which there was never a submitted plan that was submitted, any details on what that number means. Following this, of course, the COC met on the 14th of March and said that this plan is not acceptable. NCLT on its part has said that they have limited powers, because remember, that is something that Binani Industry has been trying to do. They're trying to stop this insolvency proceeding, and get the company out of the insolvency process. The NCLT has made this observation that it has limited powers as to how it can, whether it can entertain or dispose of certain matters. Although it's there in the law, typically the NCLT shies away from removing the matter once it has reached an advanced stage, such as in the Binani Cement's case. So all in all, it looks like it's going to move on to the Supreme Court for further deliberations. All parties involved have already said that they will go to the Supreme Court, but we're still waiting to hear what the NCLT finally observes at the end of the day.
And the action in Kolkata is likely to continue?
Likely to continue at least for some time, yes.
Okay. Vishwanath, thank you for that. Meanwhile, the government is said to be mulling a more relaxed timeline for the entire insolvency process. Candice Zacharias is now standing by with some details on why this rethink and when this is likely to be implemented. Candice.
Hey Harsha, thanks for that. Well, basically, the first lot of large assets are going through the bankruptcy process right now, and as they wend their way through the process, what we are seeing is that a number of the decisions of both the insolvency resolution professional and the committee of creditors are being challenged by the owners of some of these assets, by bidders, by lenders, etc. And that might be one of the things that's played into a rethink over the timeline. There are some assets where you've already had lenders thinking about looking for an extension. So under the current law, you have 270 days by which the resolution plan needs to have found approval.
Correct.
If that doesn't happen, the asset goes into liquidation, which really is to no one's benefit. So I think that's part of the reason why we're seeing some of this rethink. Importantly, of course, it's going to be on a case-by-case basis, so it's not for everyone. We still don't know whether it will be with prospective or retrospective effect. And the NCLT, it would appear, will have a final call on this. So that's the issues around the timeline, and of course it's expected at least one of the that this will come up for discussion quite quickly. So we should find out soon enough which of these proposals will actually be carried forward by the government.
Candice, thank you so much for that. That's an important development taking place on the timeline. It looks like all the development that you're seeing in court is likely to delay the entire process of the insolvency. We'll keep a closer tab on this story and how this unfolds. But let's talk about pharma now. After getting weighed down by regulatory woes for an extended period of time, there is some good news for Sun Pharma. The US drug regulator has approved Sun Pharma's filing for a psoriasis drug after spending money on development and how this is going to be, how this is going to develop. Darshan is standing by to tell us how much of a benefit this is for Sun Pharma and what's on the anvil.
So Harsha, it's good for Sun Pharma because they've been trying to develop their specialty business for a while, and finally they've got the approval. So just to give you the news, what has happened is that the US FDA has approved the Tildra drug of Sun Pharma. It's used to treat psoriasis. So that's the news. As far as the timeline is concerned, what happened is September 2014, Sun bought this drug from Merck for $80 million. Then what happened is, and Merck had already done 2 phases of that. So when Sun bought it in May 2016, they announced positive data for the phase 3 trial. So that happened when Sun Pharma bought this over. They inserted almost $250 million in developing the drug. In October 2016, they presented the case study at Vienna in front of the European Academy of Dermatology. So that is there, and they've already spent in $320 million on this drug itself. 80 million was what they paid Merck, and the balance $250 million was the R&D. And finally, yesterday they got the US FDA approval for Tildra. So that's the entire timeline, what happened for the psoriasis drug. Now, as far as the deal with Merck is concerned, Merck will manufacture the drug. Sun Pharma will market the entire drug, and they will pay royalty to Merck because of this drug, apart from the $80 million they have already paid in. Now, how big is this market? It's a big market. It's a $6 billion market for this drug. It's already crowded, but nevertheless, it's a $6 billion market growing at single digit. It's a less number in terms of growth, but remember, a single digit growth even on a $6 billion market is substantial. Now, what will happen? What are analysts factoring in? 200 to 350 million dollars is the broad range that they are expecting from year 5. They will need 3 to 4 years to actually ramp up the revenues, and revenue growth can be much higher than this 200 to $350 million. Some analysts even peg it at $500 million if the growth rate is much higher. It's a high margin product. Margin will be in the tune of 80 to 85%, but analysts see Sun Pharma's market share less than 5% because it's already a very, very competitive market. Now, what works for Sun Pharma? The firstly is the fact that, a low frequency of dosage is an advantage. It's not the most, in terms of efficacy, it's not the most superior product. Their growth in the specialty business will stem the issues that are cropping up as far as their generic business is concerned. The fourth point is the fact that it's a branded drug with high margins that will come out. And finally, it's a large market with significant amount of growth potential. What doesn't work for Sun Pharma is the fact that, it's not the most, it's already late in a crowded market. Some of the other players have an advantage of almost 2 to 3 years on this drug, so they will have to catch up, and pricing has to be aggressive. They need to offer an attractive pricing to gain market share. And finally, if you're looking at it, it's not a superior product in terms of efficacy. So that's what they need to gain out, and they need at least 3 to 5 years to ramp up the product. The reason Sun Pharma has come off significantly from the highs of the day is that, no doubt it's a positive. Most of the analysts say that, it's a 15 to 20 rupee, potential on this drug from this, and some of them say it's priced in. But remember, the peak drug revenues will come in after 5 years from them. So nevertheless, it's a sentimental positive for Sun Pharma at this point of time.
Sentimental positive indeed, Darshan. Thank you so much for that. That stock is trading in the green today. Let's move on and talk about the oil and gas sector. India's biggest oil refiner is looking to expand its capacity. IOC is trying to invest making investment nearly $3.5 billion in the next financial year. Saket Sundari of Bloomberg News now joins us with the details of what the plan is. What's the plan?
Essentially, IOC is trying to protect its market. India is one of the fastest growing oil consumption market in the world today, and IOC is the leader. So they just want to ensure that they remain the leader, they maintain the market share, and for that they need to expand capacity, because the consumption of oil and gas, or essentially petrol and diesel, is going at a rapid rate. So the company will invest almost around $3.5 billion next year, which is 20% more than what they're doing this year. And it's part of a long-term plan where the company will invest almost 1.8 trillion rupees in 5 to 7 years to move its total refining capacity to more than 100 million tons.
Where is this money going to come from, Saket? Is it going to be internal accruals, raising debt?
That's a very interesting part. I mean, given the size of the capex that they are planning, and given the size of the company, ideally would expect them to get some money from loan or bonds, whatever. Interesting, the company is not doing any of that. The market has been really good for them. Subsidies are gone almost, and the company is generating a lot of cash. In fact, all of its refineries are doing well now. On a standalone basis, each refinery is making profits. Even the latest one, Paradeep, which got commissioned just about 2 years ago, has reported, it's likely to report net profit this year on a standalone basis. So all this has helped IOC to, stay away from the debt market. And next year as well, they intend not to use any loans or bond issuances, entirely from cash accruals.
Interesting, that $3.5 billion investment plan by IOC. Saket, thank you so much for joining us. The US Federal Reserve, meanwhile, has stuck to script, hiked interest rates by 25 basis points through a unanimous vote. Jerome Powell, who is chairing the FOMC, or the Federal Open Market Committee, also projected steeper rate hikes in 2019 and 20 as the US economy improves. But this year, policymakers say they'll stick to 3 increases. Bloomberg's Kathleen Hayes reports.
This Fed decision had something in it for just about everybody, because they did raise the key rate by a quarter point to 1.5%. That was fully expected, and the question was 3 rate hikes, that is, in 2018 or 4. And in fact, they did leave the rate hike consensus, the number of dots, indicating 3 hikes this year. But for 2019, they moved the consensus up to 3. For 2020, it's also up to 3. So there's considerably more rate hikes over the next couple of years than people were looking for. Now, let's take a look at the dots themselves. Again, the individual forecast from each Fed official based on their view of the economy and where rates should be as a result. What you now see at the far left is the view for 2018, which has 6 at 3 and 6 at 4, right? And it's a very, very close call, because there's still 2 people who think, no, we're not going to get even 3 hikes, and there's 1 person who is looking for even more than 4. I guess that would be 5, wouldn't it? But you can see if one of those dots from the bottom had moved up, or one of those, a couple more, you would have had this consensus for 4. So maybe that's why, even though they didn't move to 4, it does give people the sense that there's definitely a hawkish tilt here, and that the door is wide open for 4 rate hikes, depending on the data. Our Bloomberg economics team saying that they still are betting on 3 rate hikes, but they think this decision kind of satisfied their hawkish urges, but gives them a chance to wait and see how things turn out.
Kathleen Hayes reporting on the Fed decision. Meanwhile, Fed Chair Powell sounded optimistic about the economic outlook for the United States, adding that the uptick in the jobs market is further validation of the strength in the economy. Listen in.
Indeed, the economic outlook has strengthened in recent months. Several factors are supporting the outlook. Fiscal policy has become more stimulative. Ongoing job gains are boosting incomes and confidence. Foreign growth is on a firm trajectory, and overall financial conditions remain accommodative. Job gains averaged 240,000 per month over the past 3 months, well above the pace needed in the longer run to absorb new entrants into the labor force. The unemployment rate remained low in February at 4.1%, while the labor force participation rate moved higher. Over the past 4 years, the participation rate has remained roughly unchanged. That's a sign of improvement, given that the aging of our population is putting downward pressure on the participation rate, and we expect that the job market will remain strong.
That's Fed Chair Jay Powell. Tightening policy in step with the U.S. Federal Reserve. China's central bank increased the cost of short-term loans to commercial lenders. The People's Bank of China raised the interest rates it charges on 7-day reverse repurchase agreements by 5 basis points. Now, this move is significant. It is in line with the expectations and normal reaction to the Fed rate hike. That's what the PBOC said in a statement. That's China for you. But back home, hawkish commentary from the United States has strengthened the consensus view that the Reserve Bank of India's next move will be a rate hike. But Bloomberg Economics report begs to differ. According to the report, consensus estimates are off the mark, and a slowing inflation could actually prompt the RBI to reassess its stance. Abhishek Gupta from Bloomberg Economics now joins us. Abhishek, you're differing from the crowd. Why? Why do you hope that the RBI is going to move in the opposite direction?
If we look at the inflation growth trade-off and how that is evolving, number one, on inflation, we're already seeing inflation falling, and that too against RBI's own expectations. March inflation, I'm looking at 4%, which will be a big deviation from RBI's expectation of inflation increasing to like 5.5% levels. So that's one. But more importantly, if you look at the differentials of inflation between India and the US and compare that with the differentials in the interest rates between India and the US, there has been a marked change in the inflation differentials. Prior to 2014, in the period between 2008 and 2014, average inflation in India was around 7.9 percentage points higher than that in the US. And at that point, the interest rate differentials were around 5.3 percentage points higher in India than in the US. However, over the last 2 years, inflation in India has fallen sharply, and that inflation differential over the US has been only around 160 basis points. However, the fall in inflation has not come with a concomitant fall in interest in long-term yields or the central bank policy rates, and they remain too high. This essentially means that the real interest rates in India have become much higher relative to the US or to the global economy, and India's growth is essentially paying a price for that. Even though we do see a gradual increase in growth recovery, but that growth recovery is likely to be limited to the pre-GST levels, and it's unlikely to sustain if interest rates remain too high in India. Okay,
let me just push this point a little further. So you're basically saying that the US-India rate differential, and if you compare the rate and the inflation differential, they sort of correlate to where this is going, and therefore there is a case for rates to actually head lower and not higher. What's the likely impact on the currency then?
So also the traditional economics 101 argues that if a country increases its interest rates, then the currency appreciates. So similarly, with the India and US, with the US increasing its interest rates, that's likely to push pressure on the rupee to depreciate. However, this theoretical result only holds in the case of free capital flows. In India, we do not have free capital flows.
Okay.
In fact, the controls on the debt side have over the years been that FI participation in Indian equity markets is roughly 7 times as high as their participation in debt markets. Foreign investors' holding of Indian equities is around $400 billion relative to their debt holding of about $60–70 billion, which essentially means that rate cuts in India are a play on growth, which invites FI investments in Indian equities, and that appreciates the rupee.
Okay, I have one final question. So, how do you then sort of reconcile this argument with where yields are today and where real interest rates are?
So Indian 10-year bond yields are seeing a lot of stress. In a recent note earlier this week, I had highlighted that that stress is largely due to the supply-demand imbalance in the market. And with most of the surplus liquidity in the economy having been absorbed post-demonetization, now we're looking at a neutral liquidity. And going forward, the RBI is likely to maintain that neutral liquidity stance as it has promised on a number of occasions. In order for the RBI to do that, the RBI will have to soon start making open market operation purchases of government bonds. And as soon as that happens, I think we're likely to see a fall back in 10-year government bond yields as well.
Abhishek, always a pleasure. Thank you so much for joining us. Abhishek Gupta from Bloomberg Economics talking about what this could be and a more decoupling as the underlying principle of what's happening in the US compared to what's going on here in India. That's the Bloomberg view. Let's discuss what's the impact of rising interest rates on global currency markets now. Khoon head of Asia Research at ANZ, joins us on the phone line from Singapore. Khoon, thank you so much indeed for joining us. What have you made of the commentary from the Federal Reserve? And what's the kind of impact this is having on markets, particularly the currency markets?
Well, the U.S. Federal Reserve has made it quite clear that they are going to continue to normalize policy. But I think importantly, they've indicated that they will be gradual. So they've indicated that following today's rate hike, they're going to have 2 more rate hikes for this year and another 3 next year. And this has been interpreted as less hawkish than what the market was anticipating, because the market thinking, given upside pressure on inflation, that the Fed might actually go ahead with an additional rate hike in 2018. Now, that didn't eventuate. So as a result, we've seen the dollar weakening on the back of the rate hike, and Asian currencies and markets generally taking the hike pretty well.
I'm looking at the Bloomberg dollar spot index right now, Khoon, and I see that it slipped more since January. How do you see the US dollar behaving from here on? I ask you in the context of where the US government has said. I mean, the stated position of the government is they want a stronger dollar. Do you see the US dollar strengthening against most major currencies from these levels?
I'm actually anticipating the U.S. dollar to resume its weakening path over the course of this year, and that's despite the Fed continuing to hike interest rates. Now, the reason why I expect the dollar index to continue to weaken is the Fed is no longer the only game in town, and the market has pretty much fully priced in the additional rate hikes coming in. But then you have, on the other side, the ECB, which will most likely end their quantitative easing program at the end of this year, and we're looking for rate hikes from the ECB in 2019. So that will see the euro continuing to strengthen. We're looking for the euro to rally towards 128 by the end of this year. And even the sterling, which had been negatively impacted by Brexit concerns, have been showing signs of revival. And the Bank of England will continue to hike rates this year, which will be supportive for the sterling. So we're looking at effectively the US dollar continuing to weaken. And on top of that, of course, we have concerns about weakening U.S. external position. They're going to have a much larger fiscal deficit after the tax reforms and spending package have been passed, and we're going to have a deteriorating current account position in the U.S. as well. So we expect those to weigh on the U.S. dollar.
I have just one final question, Khoon, and this is with respect to, now that we've heard from the Fed on what the rate trajectory is likely to be. What does this mean for capital flows coming towards emerging markets? Do you expect them to be tepid? What about markets like India? And consequently, where do you see the rupee behaving?
We're going to see more volatility in capital flows to emerging markets and in Asia. There's no doubt about that. I think the environment is very different from a few years back. We have the Fed increasing interest rates, U.S. yields heading higher. But not only that, we also have balance sheet normalization continuing in the U.S. And as I said earlier, we expect the ECB to end their asset purchase program at the end of this quarter. So we're going to have less ample liquidity in the system, which will have impacts on capital flows. Having said that, I think this is where the underlying growth dynamics will be very important in EM. If growth remains strong, as we do expect for most of Asia, that will continue to be attractive for foreign investors. But I think those countries that have external financing needs and where growth is somewhat less robust, and this is where India falls into that camp, I think the it will be a little bit more tricky, and I think we're going to see more volatility for capital flows, which will be impacting on the asset markets in those countries.
Khoon, many thanks indeed for joining us with your views. That's Khoon from ANZ talking about the Fed decision impact on financial markets and how currency is likely to behave. Up next, US President Donald Trump may impose fresh sanctions on more than 100 Chinese products. It might be a $50 billion impact. We'll tell you all about it on the other side.
बढ़ते समय के साथ बढ़ती सुरक्षा का वादा। LIC की जीवन प्रगति पॉलिसी, जिसमें बीमा की अवधि में हर 5 वर्ष बाद अपने आप जोखिम सुरक्षा की राशि में बढ़ोतरी होती है। LIC की जीवन प्रगति पॉलिसी।
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है।
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है। चल।
NSE Merge, साथ हमारा, सफलता आपकी। The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Back on Power Lunch, this is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Markets give up gains. Mid-cap index takes a sharper knock. US President Donald Trump may impose fresh sanctions on more than 100 Chinese products as early as today. Mark Zuckerberg breaks his silence on the Cambridge Analytica data scandal, says he's apologetic for the lapses. The Indian Space Research Organization is working on an igloo-like structure which will allow humans to stay on the moon. We'll check on how the markets are faring. It's been volatile through the last at least half hour part of the morning. Really not seeing much of direction on the broader markets as well. Yatin is standing by with a closer look of some of those stocks that are declining. Yatin.
Well, Harsha, absolutely. As you mentioned, directionless trade. We are hovering around that 200 moving average, in fact 20 points below that. If you look at the Nifty advance decline ratio also, we are almost 1 advance to 3 or 2 decline. So the advance decline ratio picture also not that great on the Nifty as well as on the broader markets. Of course, today we have the commodity stocks and oil stocks gaining. So we have ONGC, Vedanta, Hindalco, all of these stocks being the top gainers on the Nifty. On the contrary, 3-4 days in a row now we have the oil marketing companies which continue to remain weak. So BPCL and IOC are dragging the Nifty lower. 2 mid-caps to watch out for. HCC and their unit Lavasa is set to file for bankruptcy. This is what the initial news reports are suggesting. So that stock is nervous, almost 13% down last time I checked. And Reliance Communication also, that is one stock which is down 5% after the Supreme Court said to maintain status quo as far as the asset sale of the company is concerned. And among the flip side, we have IDFC, Jubilant FoodWorks and Hexaware. All these stocks up in trade on good volumes, which are the top gainers in trade.
Yatin, thank you so much for that. That's the markets for you. Let's talk about what's going on between the US and China. US-China trade war is all set to intensify. President Donald Trump is now planning about $50 billion worth of tariff against China. The administration may target more than 100 different types of Chinese goods, according to Bloomberg sources, and the value of the tariff would be based on the estimates of damage caused by China's intellectual property theft. What are the implications on the new set of tariff that could be announced as early as tonight? Bloomberg economics Tom Orlick joins us from our studios in Beijing. Tom, thank you so much indeed for joining us. this is an impending fresh assault by the US government. The former China minister has said that this would be the declaration of a trade war. How are you reading the situation?
Well, clearly the situation is deteriorating. A few weeks ago, where we were talking about steel and aluminium, it was pretty easy to laugh it off. Now we're talking about $50 billion in tariffs. We'll see exactly what that means when we get the announcement, probably later today. But clearly we're now moving more seriously into trade war territory. We still think that the impact of this on China's immediate growth is going to be a fraction of a % of GDP. Even so, we're now talking about a substantial measurable impact, and the trajectory is obviously a worrying one.
Tom, I remember the last week, a few weeks ago when we spoke about it, you called it a skirmish more than a war. Now that the situation is escalated, what's the likely scenario of the many scenarios that you anticipated?
Yeah, I think we're moving, if I can stick with the analogy, I think we're moving from a light skirmish into a much more significant skirmish. At the same time, based on our calculations, if Donald Trump imposes tariffs which are worth $50 billion, that's equivalent to roughly a 10% tariff on all of China's exports to the United States. We think that would be damaging for China. We think it would knock a fraction of a percentage point off GDP, but that's not something which is going to be particularly troubling for China on a short-term time horizon. What will be more troubling for China would be if this move towards protectionism globally throws a spanner in the works of China's industrial policy. China's industrial policy is very substantially based on catching up to the technological leaders, catching up to the US, to Japan, Korea, Germany. If in a more protectionist world it becomes more difficult for foreign firms to locate their businesses in China, becomes more difficult for Chinese firms to buy technology overseas, what does that mean for China's industrial policy going forward? I think that's the more worrying question for Beijing.
What would be the economic cost of this on the United States, Tom? Many people, many commentators have said that the US may be shooting itself in its foot by taking such a knee-jerk move. I know these are early days, but what could be the estimates?
Yeah, I mean, clearly this is not a good idea for the United States in terms of the short-term economic impact. The United States is already running at close to full employment. Wages are rising. If you impose tariffs and you cut off imports, you don't raise output, you just raise inflationary pressure. Potentially you push the Fed onto a more aggressive tightening cycle. In terms of the short-term economic impact, this is probably not a good idea for the US. The point to keep in mind, though, is that the White House isn't thinking about the short-term economics. I think they're thinking about this more in terms of grand strategy. It's who wins the great game for dominance of the global economy. And if that's what the US policymakers have got in mind, then a few quarters of higher inflation and maybe a tighter policy stance by the Fed, maybe that's a price worth paying.
You're right. Tom, one last question, and this is more, I suppose, political saber rattling. How do you see Beijing reacting to all of this? Do you anticipate retaliatory action?
I think if we get $50 billion in tariffs from the United States, it's pretty clear that China's going to have to react to that. At the same time, I think it's important to keep in mind that China is the main beneficiary from the status quo. Clearly, the status quo is going to deteriorate. The US is initiating substantial protectionist measures, but China's not going to want to amplify or accelerate that process. So I think we're going to see a response from China that's proportionate. And I think we're going to see them continuing to talk up the benefits of global trade and attempting as far as possible to kind of position themselves as the champion of that free trade system.
Tom Orlik, always a pleasure. Many thanks indeed for joining us with your views. Tom Orlik from Bloomberg Economics in Beijing, talking about the likely impact on Beijing by the impending tariff by the United States, The announcement of a $50 billion tariff is likely to come as early as tonight. We will, of course, keep you posted on that one. Meanwhile, former U.S. Treasury Secretary Jack Lew calls the steel and aluminum tariff as risky, and there's a real threat of retaliation. In an exclusive conversation with Bloomberg's Tom McKenzie in Beijing, Lew also said that the U.S. Tax cut will not help the economy in the long run.
Conflict is not going to resolve a lot of those issues. So finding ways to keep pressure on, but to constructively engage is important. I worry that when it is just left to come up to leaders without that, the risk of conflict is higher. And then when you do things like the tariff decision, it creates a lot of risk.
So the tariff decision is not the right approach in your view?
I don't think the steel tariffs are going to have a direct impact that's that big on China's economy, just because they don't export that much steel to the United States. We have to see where the exemptions end up, what the net effect of the tariffs are. If China ends up being measured in its response, that would be a good thing. I regret that there's a question of whether or not the U.S. action is based in sound foundation. This tariff decision does not seem to me to be particularly well targeted.
Do you think these reports of $60 billion of annual tariffs on a whole range of products being imported from China, could that potentially be the trigger that pushes China to retaliate? How would you expect China to react to that?
Look, what I would tell China is to not make their own actions the cause of the conflict coming to the point that you're describing. China has done many things that they rightfully are being pressured on. This excess capacity is distorting global steel and aluminum markets. It's a message they need to hear from the U.S., they need to hear it from Europe, they need to hear it from the other producing nations. What the U.S. shouldn't be is the outlier. The U.S. should be driving the world to a discussion where it leads to better outcomes.
How do you craft tariffs, should you want to target China, given the complexity of the supply chains now?
Well, look, I think that targeting actions that are violating international law, international agreement, are entirely legitimate. If there's dumping going on, having countervailing measures is a legitimate response. Putting a global tariff on steel and aluminum is not a particularly targeted approach. We're seeing the exemptions now start to build up. I mean, the idea that there was a national security reason for the U.S. to put a tariff on Canadian steel didn't make sense. I think our European allies are asking the same thing. This is a bigger question than just U.S.-China. This is a question about the U.S. place in the world. Right now, I think we have to worry about the world saying, hold on, the United States may not be doing the right thing. I mean, we have, for the last 70 years, had an alliance system with Europe and with Asia where our allies around the world could rely on us being the protectors of the rule of law. I worry that policies that weaken our leadership in the world have much bigger consequences than even what is the retaliation and the tit for tat.
Former Treasury Secretary Jack Lew on what this move towards protectionism means for the U.S. and its place in the world. Back home, despite the correction witnessed over the past month and a half, a large number of Indian equities still trade at a premium valuations. And what's more, surprisingly, a large share of the expensive stocks are from the financial sector. Jayesh Kilnani is standing by with a snapshot of some of those stocks. Room for correction still, Jayesh?
Harsha, first and foremost, this is not to imply that there could be a correction further. What we have done is a simple exercise of how the current valuations stack up against what the long-term averages have suggested. Let's have a look at some of the stocks that have been trading. These are the non-banking stocks that have been trading at a significant premium when you compare their current price to earnings ratio as with the 5-year average price to earnings ratio. So you have Bharti Airtel that is trading at 160% premium, followed by Hindustan Unilever and Reliance Industries, that has a high weightage on the Nifty, which is again, trading about 41% higher from where the 5-year moving average is, followed by some of the commodity names like Vedanta and Hindalco Industries. There's more to this list. If we can go back to that one, then you have Cipla, Maruti, Coal India. So Maruti over there, you can see that despite the correction from 10,000 odd levels to sub 9,000 levels now, it is still trading at a 25% premium when you compare the current PE to its 5-year average PE, followed by Coal India, Ultratech, and NTPC also features in that list. So these are the top 10 stocks that are currently trading at a significant premium. If we go on to the banking names, we can see that most of these banking names have actually traded at a premium as well. So you have Bajaj Finance that tops the list with a 80% premium, followed by Indiabulls Housing. At the bottom of the table, you can see HDFC Twins over there featuring in that list. That actually trades at a significant premium, 21% and 17%. And remember, both of them have a high weightage on the stocks. Now, all of this put together, how does it stack up for the entire Nifty weightage space? Let's have a look at that as well. So, all the stocks put together, the weightage on the Nifty is at about 68%, which is trading at a premium. Now, if you look at the premium being more than 50%, the stocks that were there, that has a weightage on the Nifty of nearly 4.5%. The premium being at about 30 to 50%, that is about 13 to 13.4%. But have a look at the 10 to 30% premium band. This is actually where the concern is. This actually has a weightage on the Nifty of about 46%. So a correction in these stocks would imply that a lot of the Nifty could actually slide down lower from current levels.
Okay, thank you for that. Room for correction still. Let's move on now, talk about ICICI Securities. It's the latest broking firm to hit the primary markets. The country's largest broker is looking to raise a little over 4,000 crore. Saloni Dhanuka is standing by with details on, we saw the valuations be revised before, and yet they said this is much higher than the listed guys. What's on offer now?
So after listing its life and general insurance business, ICICI Bank is all set to list its security business, that is ICICI Securities. Now, as far as the price band is concerned, it is in the range of 519 to 520 per share. Now, ICICI Bank, which owns 100% in its securities business, is looking to dilute nearly 24% through this IPO. And they will raise funds in the tune of 4,017 crores. Now, considering the upper end of the price band, that is 520 rupees, the market capitalization turns to be around 16,750 crores. Now, in terms of their business, it is the largest equity broker in India in terms of revenue and active customers trading on the National Stock Exchange. And ICICI Securities derives nearly 90% of their brokerage revenue from retail customers. And also, it is the second largest non-bank distributor of mutual fund in India, according to a CRISIL report of 2017. And also, they pioneered the e-brokerage services in India back in 2000 by launching their digital website ICICIdirect.com. Now, in terms of revenue breakup, a majority of the revenue for ICICI Securities comes from their broking business, as we can see here. Well, looking at the trend, if you see, it has actually declined from nearly 70% to 64% for December ended 2017. Well, now the company is looking to diversify into other segments, as they believe that their broking business, which is linked to market, is quite volatile. Now, in terms of market share, ICICI Securities has actually doubled their market share from 4.4% in FY13 to 9.1% currently. Now, this is despite falling customer share from 95% in FY13 to 89% now.
Okay, so if you compare this with the peers, how does it look? And what's the street saying?
So now, in terms of financials, ICICI Securities revenue, EBITDA, as well as net profit has grown at a CAGR of 19%, 38% and 45% respectively over FY13 to FY17. Now, when you compare it to other players in the industries, it is the largest equity broker in India in terms of revenue and active customers. And again, they are not only the largest, but they have also maintained their leadership position since FY14 till FY17. Now, in terms of return ratios, ICICI Securities has yielded highest return on equity for their investors, and it is currently at 89.9%, which is well above other players like Edelweiss, IFL Holding, which ranges in between to 14 to 40%. Now, in terms of valuations, ICICI Securities is the most expensive as compared to other players in terms of PE and price to book value. So for ICICI Securities, it trades around 49.6 times its earnings. Well, its price to book trades around 34.2 times, which is way expensive when you compare it to other players. In terms of brokerages, they maintain a mixed view for this issue, as IDBI Capital and Kotak Securities recommends their investor to subscribe for this issue. Well, Centrum Capital believes that they are bullish on the stock, but then they recommend their investors to subscribe to this issue for a longer term perspective. Well, on the flip side, Prabhudas Leeladhar recommends their investor to avoid this issue, as they believe that ICICI Securities is asking for too much given their higher expensive valuations.
All right, Saloni, thank you for that. In fact, Saloni and Yatin caught up with Shilpa Kumar, the MD and CEO of ICICI Securities, who's hitting the market right now. She's betting on digital savings. She also is saying having a capital-light business model is going to be advantageous, and the company is in no need of further capital. Listen into this conversation.
I think from a very fundamental macro perspective, if you look at it, there are two important things happening in the country. I think there's a big transformation of savings from physical to financial. And within that, investors are looking at, alternatives to the traditional form of financial saving, which is fixed return deposits. The second transformation is more and more of India is becoming digital. And therefore, I would say the macro opportunity for the industry which deals with digital financial savings itself is a very significant opportunity. So that's the macro landscape. Within that, if you look at the industry, and I'll talk a little bit about the broking industry, you'll see that actually over the years you have seen market share move almost 5 percentage points towards bank brokerages like ourselves. So that's the second part, in terms of industry and how it's working out.
On the valuation side, a couple of brokerages and a couple of people that we analysts we speak to say it's on the higher side versus traditional brokerages businesses which are listed. Of course, you have the ICICI Bank parentage, because of which you cannot move too much into the NBFC or other related businesses. But my question would be, moving forward, what could be the growth drivers for the business? Because I was reading some reports which said that the revenue per customer has remained more or less stagnant for last many years. If you look at the broking business also, the revenue growth has not been that great. So given the fact that the valuation that you are asking is quite high, of course that's justified partly because of good return ratios. But if you could tell us that from here on, given the competitive landscape on the online front, on the digital front, how is ICICI Securities positioning itself, and which will be the newer avenues for growth for the company?
Yeah, sure. So, one important thing I'd like to share is, with our listing, I feel we will be a fairly unique name on the listed space in India. Okay. So why unique, I'd like to spend a moment on. Unlike most other firms whom people, typically tend to compare us with, we are very capital light. So if you ask me in one word, what's our business model? We are a pure play on the financial savings trajectory of the country. It's an agency business which makes us capital light, which also means really that every year we have paid out 40 to 60% of our profits, excluding tax, as dividend.
Okay, that's the management of ICICI Securities, but let's shift focus now back to the Binani insolvency case at the Kolkata National Company Law Tribunal, the NCLT. Pradipta Mukherjee of Bloomberg News now joins us with the latest. Pradipta, what do we know?
Okay, so the hearing was inconclusive. The judge heard the petitions. The judge heard there are a total of 14 petitions, including today's SBI Hong Kong petition, and out of 14, the judge heard 4. The remaining, as well as these 4, would be heard again on 27th of March. So basically, there was a lot of argument about Ultratech not being able to bid a second time. RP's, the resolution professionals' stand is that on 8th of March, Ultratech sent only an email increasing the offer and no second plan was submitted, which is why Ultratech was not as part of the second bidding. There was also a situation where the judge, as a matter of conversation, spoke to Ultratech's lawyers saying that even if you are the highest bidder, can COC reject your offer on other criteria? So there was a lot of argument, there was a lot of hearing going on, and the judge is going to hear all of them again. The hearing went on for about 2.5 hours. just 4 petitions, 2.5 hours, and there's 10 more to be heard on 27th of March.
Pradipta, thank you so much for joining us with a quick update. That's the action from the NCLT in Kolkata. We'll keep posted on what the latest from there. Let's talk about power now. Indian power distribution companies are having to shell out a lot of money for power bought on spot exchanges. On certain instances, distribution companies have had to double the amount that they paid last year. Bhanvi Arora joins us with details of why prices are shooting up this summer. Bhanvi.
India's power utilities are going to feel the heat this summer. This is because the demand for power has increased substantially while there is a shortage of coal at the power plants. So the country's peak demand is 1,57,000 megawatts this month, which is 15% higher than a year ago. While the coal stock at thermal power plants, according to CEA's website, is 15,325 metric tons compared with 27,737 metric tons a year ago. Already the Met Department has predicted that heat wave will be above normal this summer. So also, the increase in demand for power comes at a time when the government is looking to light up 3.3 crore homes under the Prime Minister's Power for All scheme. So the DISCOMs are, to meet the demand for power, the DISCOMs are buying from the spot market where the prices have doubled in the past month. A lot of DISCOMs like Gujarat Urja Vikas Nigam Limited are buying from India Energy Exchange. Gujarat Urja Vikas Nigam Limited MD told us that they will ask for passing on to the cost to the consumer from the State Regulatory Electricity Commission, which is again a cause of worry for the consumers.
Bhanvi, thank you for that. That's power. The government, meanwhile, has just put out a draft defense policy. Sajid is here with some key highlights of what's new and what's standing out. Sajid.
You know, something which is standing out is clearly government proposes to liberalize the FDI regime for defense. Currently, they have a 49% cap there for under automatic route. Correct. And it can go up on a case-to-case basis based on niche technologies. What now they're proposing is to raise it to 74% under automatic route and for niche technologies, which they want to make it very clear there. The second one is that to increase the defense production to nearly domestic defense production to nearly 1,70,000 crores by 2025. Now they're looking at 2025 as the latest by which we should be able to reach that kind of stuff, because they're trying to say that we want to make it push all of them into India. So whether it's warships, whether it's aircraft fighters, you have or submarines, everything they have created a list, and they want to do that and bring in more private sector participation into it. They are trying to liberalize the licensing regime as well. A lot of liberalization of licensing has happened already, but now they will have a small negative list and rest all would be put out of licensing, which also means that they want to increase or allow ease of entering into defense production without much of hassle. So they are putting a 30-day cap of approval of all licenses which is coming in. One of the biggest news which is coming out from the policy is the boost for Hindustan Aeronautics. Now that's a company which is going to be listed IPO. Soon. It had ICICI coming in and bailing it out, but now government very clearly says that it wants to augment capacities to produce LCA, advanced light helicopters, light combat helicopters, light utility helicopters, and Dornier 228. This is something which HAL has been building, and this would be a big boost because that increases the backlog and order backlog for HAL going forward. So that would be something which is a very big boost for coming in for HAL, and it's been kept on the website of the Defense Ministry for comments from the public or participants, and then policy. So it will take at least 6 months before the policy comes in, but the policy
This is the thinking of the government.
Yes.
So thank you so much for that. That's the defense policy, the draft defense policy at this juncture. The Indian Space Research Organization, or the ISRO, has a new mission to develop igloo-like structures which will allow humans to stay on the moon. ISRO is already preparing for a lunar mission and has managed to successfully send an orbiter to Mars at 1/10 the cost of what NASA's Mars mission achieved. Anurag Kotaki, now from Bloomberg News, joins us with more details on this plan of ISRO's. Anurag.
The Indian Space Research Organization is experimenting with what they call structures for lunar habitation. That's very interesting because India is the cheapest explorer of space in the world. Remember, ISRO's mission to Mars was just at 1/11 of the cost of what NASA spent doing its own mission. Now this year, India does plan a moon mission which will include a rover and a lander. Jitendra Singh, the Junior Minister for Space, told Parliament yesterday that India's plan is more of keeping in mind the future. But with billionaires across the world, including Jeff Bezos, Elon Musk, and Richard Branson, all betting big on space, it remains to be seen what ISRO actually does in this space, and we should expect some updates as we go on.
Anurag, thank you for that. Out of time on the show. Thank you so much for joining us on this edition of Power Lunch. Countdown is up next.